Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization and how you can scale budget up and down and find efficiencies and make the overall marketing function far more mature. Number two, if you're a founder, a CEO, an operator, or even an investor, and you have a company where marketing is just under leveraged and you see it as a growth lever for your business to take it to the next level, you can engage with us in a 3 to 4 month engagement where we do a deep dive and look at all the possible areas where marketing can make a bigger impact on the organization and come back with a detailed set of recommendations across demand gen, paid media, ABM, content marketing, product marketing, SEO, you name it, and come back with a full set of recommendations, your entire new org design to support those recommendations, and overall budget recommendations for the business. And number three, if you have a particular business where maybe your VP of marketing was recently transitioned out, maybe they left for another job, maybe you don't have a CMO but are thinking about hiring one, well, we can fill that gap within your organization with part-time CMO services. And we do this on a month-to-month retainer, which can last anywhere between 3 months to 12 months, depending on what your needs are. And we can help set the foundation for the company and help you hire your next CMO and help onboard them into the role so that when they come into the organization, they get a running start and they're able to make an impact on revenue right away. And you don't have to wait to find the right person to get going with all your marketing initiatives. So those are all the ways. If you want to learn more, go to www.howtosas.com and schedule a consult, and we can go from there. And now on to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv Narayanan, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Josh Christensen, and he is a director at Mercato Partners. And what I really liked about my conversation with Josh is that Mercato is a minority investor in its companies, and we dug deep into how Mercato goes about adding value to the ecosystem of founders and entrepreneurs as a way to really drive more value in space. And through that, the amount of goodwill that they generate with these companies, which eventually leads to deal flow for them and their fund so they can deploy more of their capital. And I really like Josh's take because it didn't feel like a quid pro quo thing that a PE investor is doing. It really felt like they're trying to add as much value as possible. And through that, as they're investing in these companies, they've been able to drive some incredible outcomes, including taking multiple companies public. And that also builds a goodwill with the founders and entrepreneurs, because then they feel like they have a partner that can help them kind of take that journey from where they are all the way up until IPO. So I thought it was a really great conversation, and I really appreciated Josh's energy and perspective. And I think more PE firms should be thinking like this, especially if they're a minority or a growth investor. I think it would expand the ecosystem in all the different geographies where investors are located beyond just some of those central hubs that we often end up talking about or hearing about. So with that said, I'll leave you to it. Enjoy the episode. All right, Josh, welcome to the show. How's it going?
Good. How about you?
Good. Excited to have you on. So why don't we start with your background in Mercato, and let's go from there.
Yeah, of course. So I don't know which goes first. I've been with Mercato now for, I guess, almost 10 years, maybe 9. Feels like forever. Love what we're doing here. So I guess the stories are a little bit mixed. My background, I actually originally was training to be a lawyer. I practiced for a very short time. Realized while I was in law school that while I liked transactional work, it just wasn't what I was built to do. It wasn't rewarding. And I really liked the business side of the same transactions that I was working on. And so I got an MBA with it. Went back to the first tech company that I ever worked at while I was an undergrad. It was a company called backcountry.com, and joined their corporate development team, and actually got some hands-on experience, on the business side of M&A. Really loved it. We had, a great backer who was allowing us, from a really strategic level to go look at international expansion, vertical expansion, horizontal expansion across both M&A as well as organic growth. And we really, ran many of the different playbooks there. I left backcountry. I went into management consulting for a number of years. There again, it was really growth focused. Things like customer segmentation, pricing, sales team reorganization, funnel optimization, usually for Fortune 100s, but also some middle market companies. With my background doing M&A, obviously with the background as a lawyer, and then doing the strategy consulting, I helped that firm launch its first buyout fund. Kind of with the same idea, like Bain Consulting and Bain Capital. But I met Mercato while we were raising that fund. Mercato was also here in Utah. They just finished raising their third fund. It was 2016, and they invited me over to start deploying from a growth perspective. And I feel like that was really a culmination of, this background of getting some deal exposure, then really helping as an operator hands-on, to grow a business, then in management consulting, helping some large businesses really optimize their growth playbooks, and then being able to hone that into businesses where we actually had some skin in the game.
Right. That's awesome. And tell me about Mercado and kind of how you approach this, because you're involved with the marketing and sales side, and I'd say more than most firms. So can you dive a little bit deeper into that? Like, how are you helping these companies as you are investing in them?
Yeah, for sure. So, we're I think squarely pegged as real traditional growth equity. Always minority investor, always take a board seat. And we think actually there's a negative signal if a founder is ready to exit a substantial portion of their business and sell a majority. It means they may know something that you don't. And it may mean that your only real option for that business is to put on your financial engineering hat and go engineer your way to an outcome. We like to see businesses, let's say 15 to 30 million of revenue, maybe a little bit bigger, growing about 100% a year. And while some are profitable, all of them are what we call profit able. We look at the unit economics at a very, very granular level to understand, can this business sustainably defend a moat? But we're not looking for them to be profitable on day one. We'd rather see them grow. There's a really easy IRR calculation that as long as you pay a normal multiple at entry and get the same multiple at exit, then the growth rate is your IRR. It roughly holds, and that's really what we're trying to help companies with. So as a minority investor, we don't have the luxury of being able to dictate what a company should or shouldn't do, nor would we want to. These founders have gotten the business to a scale that's impressive. They're still growing. And usually the struggles that they're dealing with at that point in time are less to do with what venture has issues with, where they're trying to find product market fit. They're trying to surround themselves with experts who know their market, who maybe come from that industry. And now they're struggling with, how do we double our team size next year without ruining the culture that we've built? And how do we move from a direct sales playbook to now having two direct teams, an enterprise team, an inside team, maybe a channel team, maybe a full channel partnership program? How do we do all of that? And so the reason sales and marketing and human capital are built into the way that we do value add is those are the struggles that we see commonly across almost every company at this stage, regardless of their industry. And it's one that you can solve with a lot of resources that surround the firm, but it's really built into our DNA at the same time. Our two founders, Greg Warnock and Alan Hall, Greg came from a traditional venture background. Alan he was the founder of MarketStar, which was outsourced marketing and sales consulting group. And they built that from day one as, we're going to be a growth investor and we're going to just help with growth.
Got it. Yeah, that's really interesting. It's funny because your initial insight that if a founder wants to exit the business entirely, it's a bit of a negative signal. Can you talk a little bit more about that? Like, why is that to you guys a big negative signal versus, let's say, a founder that wants to kind of stick around?
Yeah, I think, and I think it goes beyond the founder. I think it goes to the whole executive team, but obviously to the founder first and foremost. And that to us as a negative signal, it's not like you can't generate returns there. I'm not saying that buyout groups are wrong, for seeking companies that are of that profile. But for us, if we're going to be underwriting 100% growth, um, the opportunity that sits in front of that founder, if they see 100% growth, is so exceptional compared to almost anything else that they could do at that moment in time.
Yep.
That if they don't believe in it enough, that to basically be saying I'm going to raise just enough capital to fulfill that vision, then we start to question and scratch our head a little bit of where's growth really going to come from, and how much are we going to have to re-engineer this business?
Yeah, and also in order to generate that kind of a growth rate, the founder is kind of essential to be able to
Yeah,
actually implement that because they're kind of an X factor in the company's ability to hit those numbers.
yeah, and that's I mean there was a discussion. I get my timelines confused. It was like probably 6 or 9 months ago, um, probably more actually. But when everyone was talking about founder mode on Twitter or X.com,
Yep. Yeah, that's
there
Paul.
is a different thing about having a founder involved in the business.
Yeah,
We see a noticeable difference.
there was a. It's funny you mentioned that because I think when Paul Graham wrote that article, it's like, yeah, it's so obvious, but it's like to people it was like a new idea that the founder is kind of essential to helping the business
Hmm.
grow, and it kind of it seems just so obvious, and for you guys, it seems like it's been there from the beginning.
Yeah, that's right. It's one of the things we spend a lot of time on when we evaluate companies is actually founder. There's a lot of statistics out there of what is the right background of a founder, how many startups have they done, what is their age, what is their founder market fit. But it's really really difficult to peg on one single thing, and we don't rely on a single metric. It's I think one thing that's very telling is how have they run the business so far, and how are they going to capitalize it moving forward, and you can see their belief in their business plan based on the way they capitalize that business. And then the other side of it as well, I think that sets Mercato apart. We're based here in Salt Lake City. It's where we were founded. We did probably our first 2 or 3 deals here in Utah, and then we quickly expanded into, I guess, Idaho and Southern California, and that's kind of stayed in our roots in a big way as well. Um, there's another negative signal that if a growth stage company, let's say Series C or Series D, is raising capital and they're from the Bay and they cold outreach to us, there's a little bit of a negative signal that maybe everybody else has already said no. Now, it's not enough for us to not look at those deals. We've done some deals in the coast, but we we understand that it takes something different to build a company when you don't have the access to resource that you might have if you were in New York or San Francisco. Talent pools are different, tech pools are different, and it's not necessarily harder. It's not easier. It's just a different approach to building a business. And oftentimes, the reason I bring it up is oftentimes these founders have a specific reason for building their business in their hometown, right? And they see the potential of the people around them. They see the university systems pumping out great talent. They see, um, maybe some large Fortune 100s as incubators for talent that nobody else sees. And that's something that we take pride in backing as well, is this ability to build billion-dollar businesses off the coast.
Yeah, completely agree with that. And I actually think that there are a lot of companies that are being overlooked because they're not in these markets where there is this concentration of companies and capital and
Mhm.
talent. And a lot of like Norfolk, Virginia, Birmingham,
Yeah.
Alabama, even Atlanta is exploding right now. Nashville is a great. So there's a lot of these cities where I think capital is kind of hard to find, but I think it kind of creates a different perspective because those companies are forced to be more disciplined and
Yeah.
they waste less capital and they're more efficient with kind of how they deploy resources.
Yeah, I don't have the number off the top of my head. We did this analysis for one of our annual meetings a couple of years back, and effectively, you can get to the same scale spending something like 40% less capital just in rent and not even talent, just stupid things like rent, just yeah, overhead. And it's something that we take pride in. Being having spent so much time here in the middle of the country. I think 20-ish% of our portfolio is now in Chicago. We have two portfolio companies in Missouri, a couple in Ohio. We spent a lot of time in Atlanta, a lot of time in Texas. Obviously, our team is home based here in Utah. Um, actually spent a lot of time in Southern California as well. There's pockets of the country that are very attractive from a startup perspective to get to growth stage where we play, where the companies have, to your point, had to be disciplined to get there. And it's that level of discipline that we love to back.
Totally. Yeah. And I think it leads to better outcomes as well. I think it also adds pressure, right? Because if you have taken on, let's say, $5 million more in capital than you need, now you have this pressure to become a much bigger company than that might be reasonable for you. So and then once you have money, you kind of have to spend it on something, because your board is also asking, like, why is this cash just sitting in the bank? Why aren't you spending it when that's why you raise the capital? So it kind of creates this misaligned incentives amongst these companies and the investors.
No, that's right. Yeah, exactly right. That's how we think about it.
We'll get back to the show in just a moment, but before we do, one of the most common and important value creation levers that we hear about on the show from private equity investors and our own PE partners is go to market. Yet, when these same PE partners bring us into their portfolio companies or new target investments that they're exploring, we find that the marketing function is quite immature, underutilized, and underoptimized. And so that's a huge opportunity that we see inside these companies. And if you have a portfolio company that you feel like could scale a lot faster to drive more pipeline and revenue, or you're looking at a new investment where you feel like that could be core to your investment thesis, well, we'd love to explore that with you and figure out how we can partner with you to drive more enterprise value creation on the marketing side, similar to the way that we've done with major PE firms like TA, Updata, HG, STG, and many more. At this point, we've done hundreds of engagements across hundreds of industries and verticals, and we have a ton of benchmarks and frameworks that we bring to these engagements to help you drive as much enterprise value as quickly as possible. So if that sounds like something that you might be interested in, you can just email me directly at shiv@howtosas.com or go to our website and schedule a demo, and we'd love to speak with you about it further. And now with that said, let's get back to the show. As a minority investor, okay, let's say you found a great asset, you've deployed capital into it, and obviously as a minority investor, you can't, like a buyout fund can buy a business and say, okay, this is what we're doing, this is our playbook, go ahead and run with it. You guys don't have that luxury. So how do you go about helping these businesses and identifying opportunities and almost evangelizing where those opportunities would be or where they should kind of focus to scale the companies?
We feel like the companies that we partner with are equally choosing us as a partner. They see our track record. I don't remember the exact number. Last time we did the analysis was when we were fundraising last, but something between 17 and 20% of our portfolio at any given time has achieved an IPO or $1 billion outcome. Right. We call that our slugging percentage. It may be a little bit higher today given some recent exits, but when founders see that we have a track record of finding and funding companies that get to $1 billion exits and IPO, it's a big reason to partner with us, and it's a big reason to trust that we have a lot of expertise in scaling businesses. But ultimately, at the end of the day, we are only value add when the founder allows us to be value add. And so we straddle this line of, here's all of the resource that we have, please use it, and then allowing them the time and space to pull from it. And so we've designed our value add in a lot of different ways. We've equipped our investors who sit on the boards, like myself, with different areas of expertise around, things like pricing and packaging and bundling. We have other experts outside of ourselves that are even better at that. We've always had a value add team internal that are generally ex-executives, sometimes of our own portfolio, in the departments of sales and marketing. We brought on CROs to come run, the sales program and, here for our portfolio. We also have a separate pool of capital that is executives, both from inside our portfolio as well as outside, very big names who have experience scaling businesses that we can tap into, not just to run salons, but also to just connect one-on-one with these founders. Mm-hmm. And so when you have a variety of resource, all the way down to the kind of the narrow scope of the investor who's sitting in the boardroom, out to a, programmatic team that is specialized on, specific parts of sales or specific parts of marketing, specific parts of human capital, and then zoom out even farther to have executives that are in the trenches of businesses that are 10 times or 100 times the size of the ones that are in our portfolio, but have helped get the companies to that scale. Then there's so many different resources that it's just about influence. And you build that influence actually before you ever write the check, and you make it the reason that they pick you.
Yeah, I think that's a great point, which is that in order to evangelize after an investment, they almost have to believe that you can help them before investment is even made, and that's kind of where the conversations and the understanding is really coming from. And
Yeah.
and how much of that effort are you putting in ahead of time to really sell your potential companies on, like, hey, this is our track record. This is what we bring to the table. Here are our advisors or the network of CEOs and executives that you'll have access to. Like, how much is that a part of the conversation?
We actually try and do it a bit naturally over time. I think our average company at time of investment has been tracking with us for about 18 months before we ever cut a check. And that's not a decision we're making or a decision they're making. It's just about timing of when they need capital and being the right scale. But getting to know these companies early, we're running a lot of different value add programs all of the time. So I'll give you a couple of examples. One from 8 years ago and one from probably 4 weeks ago. And they're different because technology is in a completely different space than it is today. But they're both very similar in the approach. So 8 years ago, we were running an event called Elevate. And we brought in a bunch of speakers, usually executives, who were talking about what it takes to, exceed, 50 or 100 million of revenue. And we invited basically every founder in and around Utah to this event. And I think it was a 1 day long summit. There was speakers, there was breakout rooms, there were some hands-on workshops. And one of the things that we were talking about in one of these sessions was the different approaches, because this was 8 years ago, that different companies had taken to migrate from perpetual to SaaS. And sorry, I interrupted my call there. So one of the things we were looking at was this. We talked about this summit was migration from perpetual to SaaS and different approaches companies had taken. And there was a company that was attending that event that was in the process of moving their entire code train from perpetual to SaaS. And they realized after talking to us and after talking to some other founders there that they were maybe going to require a cash bridge of some sort. They'd never raised money before to be able to effectuate that transition. And given that we'd done it before, and given that we were, I guess, smart enough to talk about it, they saw that as a real value add. So they started approaching us, just getting some insights about how they would do this transition. And ultimately, when it came down to raising $15 million to help with this, cash transition, we were the first priority. I don't think the only ones, but the ones that they cared about most in terms of a partner. And you fast forward to today, that company is now crossing 100 million of ARR. They're about 7 times the size they were. We've helped them move over to full SaaS. They've hardly touched any of the cash that they raised. And, by all accounts, everything worked. And, that's one where, we kind of found the opportunity because they came to an event. Another one, if I just take, 4 weeks ago, and I'll make this one a little shorter, company we've been courting for a couple of years. We're just waiting until they're the right size and scale for us. We ended up hosting an AI event here in Utah, just a very small, kind of intimate setting. We had a couple of CTOs speak at it. One of the CTOs is of a company here in Utah that I think just went public this last month. And he was talking about his approach to AI. And we ended up spending some time with some of the different founders afterwards, really hands-on, giving some examples of different approaches that you can take to implement some AI in your product today, how you can think about your product roadmap, product teams, engineering, where we spent a lot of time getting up to speed on AI over the last couple of years. They ended up taking back some of those learnings to their team. Within a week, they launched an AI product that's competitive in an adjacent market. After all of the benchmarking against all of the traditional software tools in that adjacent market, this AI product actually beats it on almost every metric. It took them a week to build it. And it's because they have some proprietary data that it's so valuable. But they ended up launching it to customers only 2 weeks later. So they went from idea in a meeting with us to a launched product that now has, I talked to them a couple of days ago, something like 30% adoption already in the matter of 3 weeks. And so they leave a setting like that and they're like, you know, their confidence in Mercato as being a value add investor, I think goes way, way up.
Yeah, I love both of those examples. And one of the things, actually, we've had this conversation with a few PE investors that, in a way, a PE firm is also has to market itself to get the deal flow and the pipeline from founders to really believe that this is the right partner for us. And yet I don't see enough firms investing into the type of work that, let's say, a B2B company would do. A B2B company would hold events for its users. It would go to conferences. It would create content to educate its market. And I think more private equity firms need to be doing stuff like this, like bringing companies together, even if they're not part of your portfolio, because that will lead to deal flow in the future, right? And a lot of these things kind of happen organically, like putting your existing portfolio with potential portfolio companies. There's this cross pollination and this trust that's built that cannot really be duplicated if another firm is not doing that. And that kind of gives you a strategic advantage in your ability to actually deploy your capital.
No, that's right. And for us, it's interesting because the way I've always thought about it is I'm dedicating my life to, growth investing and helping these founders, go from 20 million to 100 million to 200 million of revenue scale. And there's when you really zoom out and you think about what you're doing for an ecosystem as you build a fund and you build a pipeline of companies and then you fund those companies and they start growing and they start exiting. The reason that Utah has such an attractive tech economy and the reason that other pockets of the country have something similar to that is that we're just repeating the cycle of what has happened for a couple of decades. And here in Utah, that started with a company called Novell that had an exit, and that seeded a bunch of other startups. And some of those startups turned into successes, and one of those was Omniture. And then Omniture exited to Adobe for over $1 billion, and that seeded some new startups. Led Josh James to found Domo, and then led to Silicon Slopes and Qualtrics and Pluralsight and a bunch of others in that era. And now we're seeing a whole new era crop up of additional successful companies here. And it really is what I think separates America in some regard from almost any other country is this entrepreneurship and having a mechanism to fund successful outcomes, having a mechanism to allow entrepreneurs the freedom and the flexibility to build something new is really what keeps the economy going. It's certainly what's kept the economy strong here in Utah and in other parts of the country. But the reason I say that is that I think you can have a handful of different approaches as you think about investing. And the one that I've always tried to hold, and the one that I know Mercado's always tried to hold, is if first and foremost what we're doing is just helping the ecosystem of entrepreneurs grow their businesses, then everything else will take care of itself. And so you're completely right that there's some level of marketing going on here. But at the same time, these are the things that we want to be doing for all of our ecosystems. We want to be hosting these events. We want to be getting these founders together. It makes everyone better, and it just leads to more success across the board, whether or not they're in your portfolio.
Yeah, 100%.
Like a rising tide raises all ships, right? So that's kind of the lens we put on it.
Yeah, I think it's beyond just the promotional side of a PE firm. It's like looking at the mission and the broader impact that you're making on the ecosystem and the community. And through that, just goodwill just comes back to you. It's not even like on purpose. It's just you're trying to create as much value for everyone involved as much as possible.
That's right.
Yeah. It's funny, by the way, Utah is where we got our first client at How to SaaS. Our first client ever was a company called Filevine out of Provo. So,
oh, yeah. We know Filevine very well.
So Ryan Anderson was our first client.
Yeah.
There you go.
That's awesome. That's amazing.
Yeah. Small world. Yeah.
One that we missed, I guess.
So you missed on that one. They're crushing. Yeah. Well, anyways, yeah, I think that's great. Talk about the community side of it and how you're actually once the companies are actually growing bigger. Like, How are you enabling those folks to like connect with even prospective companies, and how much of that is like this closed loop cycle where you're kind of building more pipeline or deal flow for your firm through your existing successes?
I think success begets success in this industry. People see, that you're successful. It attracts additional companies to you. You go back to this slugging percentage, metric, and I think it does matter, to founders. But ultimately, I think all you can stand on at the end of the day is your reputation, and that's a spot where we've spent, so much time building relationships with founders both inside the portfolio and outside the portfolio in what I would characterize as just the most genuine way possible. Like, you zoom back out to that mission I talked about, and if you're in this game to just deploy capital and generate a return, you'll do great. But if you're doing this because you actually care about entrepreneurship and you actually care about funding success and building GDP and returning capital to LPs, who many times are pension plans and retirement systems, and they're dependent on these returns to be able to fund those plans, and you really kind of holistically just care about the ecosystem, then I think what naturally happens is that becomes a bit infectious. And, founders who see an exit, they want to get back involved. They want to be mentors to other CEOs. They want to be LPs themselves. And, when they do that, that's why we actually launched our executive fund. Was there's enough demand around us, not just from our ex-executives from our own portfolio, but just in our ecosystem to say, we'd love to be helpful and we'd love to put some skin in the game while we're at it.
Mm-hmm. How do you talk about the economics of building this type of a culture and then also having this performance team at Mercado? Because you're minority investors, like I get really large funds investing in large operating teams. Like, how do you guys look at the economics of that as you're making these investments and having that be almost like a fixed cost for the
Mm-hmm.
firm?
When we connect somebody to a value add resource that's outside the firm, um, these are large enough companies that they can engage with anybody that they want. When you're doing 40 or 50 million of revenue and you're approaching some level of profitability, um, I think what you're struggling with is not how do we afford to hire a consultant or hire this executive or have conversations with somebody who's going to have an impact on the business. What you struggle with is determining who to talk to. And so where we spend our time in a lot of ways is actually getting to know the right value add resource. And sometimes that means hiring them internally and we make them part of our team and they share in the economics the same way everybody else does. Other times they're outside the firm. And in those cases, what we're trying to do is actually just vet resources and make sure that we're connecting our companies to the right resource. Whether that's a pricing expert, and oftentimes we'll say, we know 3 pricing people, and one of them is going to probably charge you, $30,000, and the work output's going to look like this, and this other one's going to charge you $500,000, and the work output's going to look like this, and then we have a couple options in between, and here's the one we think you should pick based on the need, and it's a lot of outsourced work that way.
Mm-hmm. Yeah, and we see this with a lot of firms. So we've heard this even from large firms that outsourcing the work allows them to keep their internal team more lean, and they can kind of pull different expertise based on what the need is at a particular business. So that's
That's right.
yeah. We're coming up on time here, but just before we wrap up, like if somebody wants to get a hold of you or learn more about Mercado or even have you as an investor, like what's the best way to get in touch?
Yeah, we try to spend as much time as we can in these what we think are the most attractive pockets of the country. It's most of the cities that we've named today, plus others. And so we hope that we're spending enough time there that if there's a founder in one of those regions, they already know us. But we know that we can't talk to everyone and we can't cover the entire country at all times. So, look for our events. We'd love to have you there. Reach out to myself. I think we'll include some contact info. My email is just josh@mercadopartners.com. It's very easy. We host events all over the country all the time. And first and foremost, what we're hoping for is just entrepreneurs to be successful. And if that leads to an opportunity for us to partner with any founder, we welcome that opportunity, even if just for a conversation.
That's awesome. And we'll be sure to include all of that and the links in the show notes. And with that said, Josh, thanks for coming on and sharing your wisdom, especially as a minority investor. I think it's one of the best programs that we've seen a firm run to build goodwill and really contribute back to founders and entrepreneurs. So I appreciate you coming on and sharing your wisdom.
No, I appreciate it, Shiv. Thank you.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosaas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.